Welcome to our financial analysis of Palo Alto Networks and Juniper Networks. We'll start off with the introduction of Palo Alto Networks. Palo Alto Networks began in 2005 in the cybersecurity and firewall technology domain. Their competition consists of Sophos, Cisco, Juniper Networks, and their key drivers are the reduction of network security costs, the increase of prevention to cybersecurity attacks, and their high-quality services delivered to clients. Their challenges consist of expanding volume and complexity of cyber attacks, the movement to the cloud, and sales execution. Juniper Networks, on the other hand, began in 1996 as a basic telecommunications domain company. Their competition consists of Cisco, Extreme, and Palo Alto Networks. Their drivers are the client companies' movement to the cloud, the acquisition of cloud computing software companies, and inclining network switching segments. As far as the challenges go, they rely heavily on clients moving to the cloud, and they need to watch out for the declining network security segment and the declining cash inflow due to architectural restructuring.
Coming to the street position of Palo Alto Network, we can see from the stock price graph, its current market position is bullish. So we can see from the graph on the left that most analysts recommend that we should buy this share. Then the current market price is $200. The stock price has been increasing each year. And then coming to the forecast earning growth over the next 5 years, the analysts that follow this company are expecting that it will grow 20% annually. In 2018, earnings are forecast to increase almost 80% over last year, and analysts expect earning growth next year of almost 200% over this year. Then when it comes to the street position of Juniper Network, we can see from the graph on the left that most analysts recommend we hold this share for some more time because we can see from the stock price graph that the stock price is fluctuating over the years, and its current market price is $26. The stock price has been fluctuating over the years. Then when it comes to the forecast earning growth over the next 5 years, the analysts that follow this company are expecting it to grow on earning at annually 5%. This year, analysts are forecasting earning decrease of minus 30% over last year, and it is expected that next year of 30% over this year's forecast earnings.
Now let's look at the business segments for Palo Alto Network. The company has been divided into three main core segments, which is next generation firewall, advanced endpoint protection, and threat intelligence cloud. The next generation firewall offers security solutions in several physical and cloud-based software form factors. The famous products are Panorama and Threat Prevention subscription. The advanced endpoint protection offers prevention against cyber attacks and from malicious user. Some famous products in this vertical is TAPS endpoint protection subscription. The Threat Intelligence Cloud provides security solutions for SaaS applications and automated delivery of prevention against cyber attacks. Some of the important products in this domain are Global Protect Cloud subscription service and Aperture subscription. The key business drivers for Palo Alto Network have been their expansion of products in firewalls with launch of several new applications for SMBs and LE and their 3 new VM series virtual firewall models. They have also delivered many important software that expand security for public and private cloud, and they recently acquired a company called Lightsaber Limited, which expands their functionality of their platform in offering behavioral analytics and will be foundation for new future offerings. Now let's look at business segmentation for Juniper Network. As Palo Alto Network, the company here is also divided into 3 core segments, which is cloud, telecom, and strategic enterprise. Cloud verticals are composed of all the SaaS, PaaS, and IaaS offerings. The telecom vertical includes wireless and wireline carriers, and strategic enterprise caters to high performance network infrastructure, mainly which are the data centers. The key business drivers for Juniper Networks is their leveraging position of suppliers of high performance network infrastructure, establishing and developing industry partnerships, increasing customer verticals, and maintaining and extending technology leadership. Now let's look at business risks for Palo Alto Network. The major risk for Palo Alto Network now has been the budgeting cycles and seasonal buying patterns of customers, changes in growth rate of enterprise security market, increased expenses and unforeseen liabilities, and write downs, the cost of potential outcomes of litigation, the political and economic and social instability, and changes in the multi-year subscription and support model, which is their growing source of revenue now. On the right side, you can see the magic quadrant for enterprise network firewalls as of July 2017, and as you can see, Palo Alto Network is among leaders, so they have a lot of risks right now. Now let's look at risks for Juniper Networks. The major risks for Juniper Networks that they anticipate are changes in their current and potential customers, partners, and supplier consolidation and concentration, changes in tax law or accounting rules, price and product competition and long sales qualifications, and implementation cycles. They have been facing huge problems in this segment, regional and economic and political conditions, changes in amount of frequency of share repurchase or dividends. Then again, on the right side, you see the magic quadrant for enterprise network firewalls, and you can see here that Juniper Networks is one of the niche players. And when we compare risk, as per our analysis, it feels like the Palo Alto Network has more to lose than Juniper Networks.
So let's talking about horizontal analysis. It can be seen from the chart that the current asset, current liability, and total liability of Palo Alto Network are much higher than Juniper Network. But Juniper Network stockholders' equity is significantly greater than Palo Alto Network. Coming to the horizontal analysis of income statement, it can be seen from the chart that Palo Alto Network has net loss, and it is decreasing from 2016 to 2017, when Juniper Network has net income over the 2 years, but its net income is decreasing from 2016 to 2017. Coming to the vertical analysis of balance sheet in 2017, the percentage of current asset, current liabilities, and total liabilities of Palo Alto Network is greater than Juniper Network, but for stockholders' equity, Juniper's is much greater than Palo Alto Network. Then talking about the vertical analysis of income statement in 2017, the percentage of gross profit of Palo Alto Network and Juniper Network are similar. The percentage of total operating expense of Palo Alto Network is higher than Juniper Network. For Palo Alto Network, because it has net loss, so its percentage of operating income and net income are negative.
Juniper Networks ratio analysis consists of 6 key ratios. The first of which is the current ratio that shows that they are trending towards more unused investments. The second is the quick ratio, which shows that they're invested in mainly short-term investments due to the relationship to the current ratio. Gross margin shows that they have a small trend down, meaning that they are losing efficiency. The operating margin shows the possibility of increased competition is causing the upward trend to tail down in 2017. And the profit margin is decreasing due to increased tax costs. And the after-tax return on equity shows that profit margin is directly correlated to the drop in return on equity. Palo Alto's ratio analysis consists of the current ratio, which shows that they are inefficient at converting products to cash. The quick ratio shows that they walk the line between being mathematically available to pay liabilities in the short term. The gross margin shows the that they are able to generate sales consistently. The operating margin increases due to inefficiency or increased competition. The profit margin is low, showing that they have many R&D ventures. And the after-tax return on equity is stable but low, also due to R&D ventures.
Now let's see if an investor would like to invest in either Palo Alto Network or Juniper Networks currently. As you can see from the first graph, the price of a single share for Palo Alto Network is 203.86, and on the right side you can see the stock prices for over a period of 3 months, and you can see a steady growth, which shows that Juniper has been showcasing good performance over a period of time. But if you look to the last table on the right, you see that earnings per share is negative, and earnings per share is an important financial measure which indicates the profitability of a company. So also the operating profit for Palo Alto Networks is negative, which could be a cause of concern for an investor. Now let's look at what's happening at Juniper. So as you can see, the Juniper stock prices have also shown a steady performance over a period of time, which is like for 3 months, and it's currently at 27.31. So an investor has to spend a lot less to buy Juniper share compared to Palo Alto Network share. And if you look at their earnings per share, you see that it's plus 0.80 compared to Palo Alto, which was in negative, and even their operating profit is also 2.38, which shows on that they are generating some profit, but this is not the whole story. Now let's summarize what we saw in the earlier two slides. As you can see, price per earning ratio is higher, signifying a steady growth for Palo Alto Networks, and price per earning ratio is one of the most widely used tools for stock selection. Whereas in case of Juniper, earnings per share is better than Palo Alto, which means that company earns more profit per share basis. If we follow performance, then Palo Alto is the right place to bet, as they have acquired big clients in the first 2 quarters, such as they recently snatched a big contract from Cisco, they got a contract for Amazon Marketplace, and so on. If we go to Juniper Network, it is higher profit margin, which goes on to indicate that they can meet their debts obligation more efficiently than Palo Alto Networks. And if ROI and ROV is concerned, Juniper has done slightly better than Palo Alto Network, but Palo Alto Network has shown strong growth in all their divisions, and their subscription and cloud vertical has grown significantly.
For the creditors to decide for capital investment, they need to consider the following financial ratios: debt to equity ratio, asset turnover ratio, quick ratio, and current ratio. Creditors look at the debt to equity ratio, since this ratio shows how much is owed with respect to how much is owned. A lower ratio is preferred. Juniper Networks has a lower debt to equity ratio. Asset turnover ratio. Asset turnover ratio gives an idea to creditors on how efficiently the company is using their assets to generate revenue out of them. Asset turnover ratio for Palo Alto Networks is better as compared to Juniper Networks. Quick ratio shows the liquidity of the company to pay its current liabilities with its quick assets. Juniper Networks has a very high quick ratio and is preferable by creditors. Current ratio shows how the current assets can be used to pay back the current liabilities. Creditors will look for a high current ratio, and Juniper Networks has a stronger current ratio. The financial health ratios are a major factor influencing the creditors' decisions. Creditors would prefer to lend capital to Juniper Networks since the company has a better debt to equity, current ratio, and quick ratio. We conclude by choosing Palo Alto over Juniper Networks. The stock price of Palo Alto Networks is 201.75, and it is increasing over the last decades. Its earning is predicted to increase 23.42% annually for the next 5 years, while the stock price of Juniper Network is 26.66, and it is fluctuating and hard to predict its performance for the following years. The earning of Juniper Network is expected to grow only 5.72% every year for the next 5 years. From street position analysis, Palo Alto Network behaves better than Juniper Network. Pricing pressure has led to lower gross margin for Juniper Networks, a trend expected to continue in the near term. However, disciplined expense management and improvement in the company's cost structure led to a substantial increase in Juniper's non-GAAP operating income. In an attempt to improve profitability and earnings per share, Juniper could continue to improve its cost structure in coming quarters. Palo Alto is benefited by the combination of the efficiency and newly introduced tools. Also, Palo Alto has been benefiting from the series of cyber attacks last year, which results in constantly increasing gross margins. Palo Alto has a high profit margin as compared to Juniper Networks, even though Palo Alto has spent major part of its revenue on research and development. Palo Alto is trying to build its existence in security domain by investing more in research and development, but Juniper has to maintain its well-established existence in security domain. Profitability ratios measure the returns generated on sales and investment, hence the ability of the company to generate profits. According to our analysis, Palo Alto has a better growth rate and profit generation as compared to Juniper Networks. It has a growing market share over its competitor, that is Juniper Networks.